What happened with the well-known edible oil company Ruchi Soya? Well, let me tell you. While some like to call it a multi-bagger, others call it multi-beggar. Why so? Let's go back. So once a penny stock trading at 10 to 15 rupees in 2017, by 2018 the share of Ruchi Soya plummeted to around rupees 3, erasing 90% of its value. Investors who bought in during the decline faced severe losses as the company struggled with debt and insolvency. But then in 2019, Patanjali Ayurved took control and the stock soared to 1100 rupees by 2021. While some investors saw massive gains, many others were left with huge losses, stuck holding a crashing stock. This is the reality of penny stocks, the potential for big profits, but also the risk of even bigger losses. Ruchi Soya's journey shows how volatile penny stocks can be. A low price stock today may skyrocket tomorrow, but the road to those profits is often bumpy with high risks. So should you invest in penny stocks? Let's take a deeper look at the factors you need to consider. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss basics of investing and personal finance. Penny stocks are shares that trade at very low prices, usually 10 or 20 rupees in the Indian market. These stocks are typically from small struggling companies or those with very low market capitalization. They can seem like an attractive option because you can buy lots of shares with a small amount of money. However, penny stocks come with extreme volatility. Their prices can swing wildly based on rumors, speculation, or just lack of liquidity in the market. While some traders might get lucky, the reality is that most penny stocks either fail to grow or disappear entirely. If you would argue that so many penny stocks are making mammoth returns for investors, well, out of thousands, there are a few which became bigger and the investors got lucky. So these are the companies that are talked about and are covered everywhere. But then there are many other companies which just vanish away and are never spoken about, wiping off investors' money silently. An amazing example is Vakrangee, a technology-driven company that provides e-governance solutions. Initially saw its stock price rise by around 550% from 10 to 15 rupees in 2012 to nearly 500 by early 2018. The stock gained attention due to the company's plan to expand its business across e-governance, banking and retail services with the narrative of becoming a fintech giant in rural India. This was further fueled by the excitement surrounding the company's Vakrangee Kendra stores aimed at providing various services to underserved regions. But after reaching its peak, the stock plunged in 2018, largely due to concerns over corporate governance, regulatory issues, and suspicions about the company's reported revenue. Investigations revealed discrepancies in the company's financials, and the stock price crashed from 500 rupees to below 40 within a year, wiping out massive investor wealth. The stock has struggled to regain investor trust since then, and the examples are plenty. So the truth is that penny stocks are not a good choice for most investors. In fact, the risk is so high that many people end up losing all their money. But let's understand, why are penny stocks so risky? There are a few reasons. Lack of information. Penny stocks are usually not covered by analysts or mainstream media, meaning there's little reliable information for investors. This makes it hard to assess the real potential or risk of a stock. No track record. Many of these companies are either very young, struggling, or in industries that are about to die out, so their stocks have no solid history of growth or performance. Manipulation and scams. Penny stocks are often targeted by pump and dump schemes, where the price is artificially inflated only to be sold off by the insiders once the price has spiked, leaving everyday investors holding worthless shares. Lack of liquidity. Penny stocks often trade in very low volumes. This means it could be very hard to sell your shares when you want to, especially if there is no market for the stock. Now, if you are still not convinced, let me give you 4 very clear reasons why you should avoid penny stocks as a beginner or even as a seasoned investor looking for long-term growth. Number 1. Unpredictability. Penny stocks are too volatile. You can't predict whether the price will shoot up or crash down. One day it's up, the next day it's down, and sometimes it's gone entirely. Number 2. The risk of losing everything. As we saw with examples, many penny stocks end up disappearing either due to fraud, mismanagement, or insolvency. If you invest in them, you could easily lose 100% of your investment. Number 3, short-term focus. Most penny stock traders are focused on quick profits. They chase the hype and ignore the long-term fundamentals. As a result, they end up losing money, especially when the hype dies down or the company faces a crisis. Number 4, lack of regulation. Penny stocks are often not well regulated, and many of these companies are small enough that there are fewer oversight mechanisms to protect investors. In fact, some of these stocks are used for market manipulation, where prices are artificially inflated and then crashed after retail investors jump in. If you are a beginner in the stock market, the best strategy is to start with blue chip stocks, that is, the larger companies, or mutual funds that have a proven track record and strong financial fundamentals. We have created videos around the same. Do watch them. And it's a wrap. If you enjoyed this video, don't forget to like, subscribe, and click that bell icon so you won't miss any future videos. Thanks for watching, and I'll see you in the next one.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.